What if I told you that correlation could be your edge in trading? Here is an example of two correlated assets. ES, the S&P 500 futures on the top here, and NQ, the Nasdaq futures. And this is a 1 minute time frame. And this is how they look on a higher time frame, the daily time frame. They look pretty much the same, right? The difference is the volatility. The daily ATR of ES is almost 100 points, and NQs is around 460, 470 points. And do you know how I know? NinjaTrader has an indicator called ATR, Average True Range. It simply measures the difference between the high and the low of candles, let's say daily candles. So for ES, this was 6,100, for instance, and the low of the candle was 6,000. So the difference between the high and the low of this daily candle was 100 points. So the daily ATR considers 14 daily candles. The difference between the high and the low of 14 daily candles, it averages, and this is the daily ATR of ES, for instance. So let's say the difference here was 90 points, and the distance of this daily candle was 95, and here 110, and so on and so forth. The average for ES over 14 daily candles is the daily ATR, which is around 100 points. This is the daily ATR of ES. And for NQ, if we do the same, we will get that its daily ATR is around 450, 460, 470 points. And by the way, you don't have to compute it by yourself. NinjaTrader has an ATR indicator. You just need to move to daily candles to get the daily ATR and attach it to your charts to see the daily ATR. So this is the daily time frame of ES and NQ. You can see at the bottom here, the ATR indicator attached to ES and NQ charts. And here is the value of the daily ATR for ES and for NQ. So it computes the average of the ATR over 14 candles, daily candles, the difference between the high and the low. This is the daily ATR for ES and NQ. Now, let's get back to a 1 minute time frame. Still, as you can see, they look the same. As day traders, guys, we're always looking for edges. You agree with me. But what if I told you that correlation, something most traders overlook, has been the most powerful method in my trading arsenal? In my CTP program, I'm going to break down why correlation matters, how most traders get it wrong, and how my correlation methodology completely changed my trading game. So again, welcome to this exciting journey, and thanks for joining me. What is correlation in trading? In simple terms, correlation measures how two instruments move relative to each other. A correlation of +1 means they move together. They look the same, like ES and NQ. 0 means no relationship at all, like ES and gold. And -1 means they move in opposite directions. For instance, USD and gold. So this is a perfect correlation. This is no correlation. They don't look the same. I mean, no relationship at all. And negative correlation means they move in the opposite direction. Sounds straightforward, right? But here's the thing. When it comes to spotting exact entry points, this is not that simple. It turns out that many traders get correlation wrong. they check correlation values, see that ES and NQ are highly correlated, and assume that means their price movements are predictable. However, correlation values only show past relationships. It doesn't tell you where the trading opportunities are forming in real time. The issue, guys, is that correlation is not a fixed relationship, and there's a need for concrete references for timing your position entries. So most traders assume that if two assets have been correlated in the past, they will always move together. But markets are dynamic. Correlations shift based on economic conditions and order flow. For instance, I attached a basic free correlation indicator to my NinjaTrader chart. It shows correlation values down here, considering ES and NQ. This is unuseful for me. As you can see, the correlation shift over time. The indicator lags, and it does not provide me with concrete, actionable insights, concrete entry points. That's why there's a need for a concrete reference that adapts to market changes daily. For instance, the EG trigger point, which provides you with fixed key levels daily, and it adapts to market changes. So how the correlation approach can be combined with our trigger points. So where my approach differs, instead of just looking at historical correlation numbers, imagine if you had a tool that could show you how correlation behaves right now. A tool that doesn't just give you a number, but visually maps out where price movements align and when and where they break apart, spotting to concrete opportunities. So instead of relying on lagging correlation values, this tool can give you a real-time look at how assets move together. It visually maps price relationships so you can see where assets are actually in sync, providing you with concrete entry points. And that's exactly what my correlation methodology does. Let's take a closer look at how it works and what makes it different. You can see NQ at the top here and ES at the bottom. I identify an A+ setup. Why? Because both ES and NQ are reaching their resistance level at the same time. And there's a high distance between the levels. So to me, it's an A+ setup. According to the correlation methodology, NQ's resistance and ES resistance are equivalent levels. Remember this term, equivalent levels. So I'm entering here on both with 2 contracts. Regarding the profit targets, one possible profit target can be a support level, trigger point. But here's the thing. While ES has a support level down here, NQ doesn't. So I'll exit with one contract on ES when it reaches its trigger point support level, and I'll do it on NQ at the same time. To me, ES support level is a good profit target for NQ as well. So this is with one contract. In addition, I want to put another profit target closer. I identify an intraday support level on NQ and ES, intraday support levels created by both. I mark them, and I place the other profit target here for both. So first profit target is an intraday support level created by both together, And the second profit target will be ES trigger point support level. Now, look at this, guys. ES broke its resistance, turned into support, probably. NQ did the same. NQ is in a narrow zone, I would say, but I'll scalp here. I'm going to place a buy limit order here of ES support level, but I'll monitor NQ and see what it does. So I'm waiting for my limit order to get filled, and I'll probably exit the position of NQ's resistance. Okay, it's a bit confusing, but I'm sure you'll get this point. You see ES generated an intraday resistance level equivalent to NQ's trigger point resistance, so this was a good profit target to me. Now, here is the correlation indicator. The correlation indicator generates correlation signals for me, so I don't have to monitor the markets. You could see the short trade that I've taken, you could see the short correlation signal on the left here, and long signals here, and beautiful short signals here. Now let's focus on ES. You understand that the EG correlation indicator monitors the markets for me, aiming to spot equivalent lines. It identifies the reaction of two correlated assets when both are reaching a trigger point, automatically generating correlated signals for me ahead of time. Guys, the signals are generated ahead of time when the markets get close to the trigger points. That's the beauty of it. You can see how, by its nature, the correlation methodology filters out weaker lines. This is also the beauty of it. Now, let's take it a step further and see a possible way to decrease the number of signals. ES and NQ highly correlate. Many signals can be generated off our trigger points. So my trick is to add another instrument like RTY. So I extended the EG correlation indicator to EG correlation multiple, which is capable of monitoring two instruments for me. For instance, NQ and RTY. So NQ and RTY are being monitored in the background to produce correlation signals for me on ES. Similarly, we can replace RTY with YM. So NQ and YM can be monitored to produce correlation signals on ES for me. Now I want to talk about a key concept in my CTP methodology, equivalent lines in correlation. During my research, I discovered that the real value of correlation isn't just in numbers, it's in the price section itself. We are looking for moments when two assets are reaching their significant price levels. These parallel movements can help you anticipate price behaviors allowing you to spot high probability setups. In these examples, these lines are considered equivalent. Why? Because ES and NQ reached them together and bounced off. In this example, these lines are considered equivalent, providing me with A+ setup because both reached their resistance lines, these equivalent lines, together and bounced off. In this example, there was no trigger point for ES, but there was a trigger point for NQ, and by identifying the double top here, you could realize that an intraday resistance is created by ES equivalent to NQ's trigger point resistance. And here is another example taken from a live session we conducted together on Discord. We identified that ES and NQ are reaching their trigger point resistance levels together. To me, guys, this was an A+ setup, especially due to the large movement both conducted until they reached their resistance levels, indicating a possible weakening. Now, I have two questions for you guys. What lines are equivalent here? Considering the trigger points as targets, where would you exit on NQ? Because you see, there's no line here. How do you know a possible profit target for NQ? So you understand that this support level of ES could be an exit signal for NQ. If we summarize, significant price levels can be monitored to spot potential opportunities when considering correlated assets and their reactions to their levels. A correlated asset significant level can be used to spot potential targets also. And according to my CTP approach, correlation trading is about spotting equivalent lines. These are levels corresponding to two correlated assets when they are reaching their significant levels at the same time. Simple? Almost. The problem with over-correlated assets. Here is the challenge. Sometimes assets are too correlated. When two assets move exactly together, like ES and NQ, the signals can become too crowded. It becomes maybe harder to find clear entry points, sometimes. Not all the time, but sometimes. Here or here, that's where the third asset trick comes into play. So when two assets are too correlate, we introduce a third asset to break the tie. This third asset helps us confirm the move, acting as a filter for false signals. For instance, if ES and NQ are too close to call, adding RTY can give us the extra confirmation we need, because the probability of RTY of moving in a crowded zone at the same time is low. And this technique can be useful to filter out weak lines on ES and NQ. Just add another instrument to the correlation analysis. This approach takes correlation analysis to the next level. Instead of just looking at numbers, we are using real-time visualization, parallel price action, and the third asset trick to filter out noise on two correlated assets, to filter out weaker lines in crowded zones. This can give you better decisions, clearer confirmations, and more confidence in your trades. In this program, you'll get access to the EG correlation toolkit, which contains the EG correlation and the EG correlation multiple indicators. During this program, you'll discover their strengths and weaknesses and learn how to take advantage of them for better trading decisions. Now that you understand the power of this approach, let's look at some real market examples and how you can start applying it today. Speaking about equivalent lines, let's take a look at a very interesting case study. Significant price levels like the trigger points are magnets. In this example, you can see how a correlated assets level can help you identify false breakouts. ES is trying to reach its magnet, which is a high probability reversal zone. When this happens, NQ reverses. So you could anticipate that this break is a small false breakout by looking at ES that it's reaching its resistance level, possibly indicating that NQ is going to break down. So it's a false breakout. ES is reaching its resistance, NQ bounces off support. On one hand, we expect the buyers to take control. On the other hand, we expect the sellers to take control. This is what I call disagreement. One of them must give up. Possible solutions? The first can be to avoid trading in such cases. Another solution can be adding a third instrument to the correlation analysis. Now let's focus on ES. You understand that the EG correlation indicator monitors the markets for me, aiming to spot equivalent lines. It identifies the reaction of two correlated assets when both are reaching a trigger point, automatically generating correlated signals for me ahead of time. Guys, the signals are generated ahead of time when the markets get close to the trigger points. That's the beauty of it. You can see how by its nature, the correlation methodology filters out weaker lines. This is also the beauty of it. Now, let's take it a step further and see a possible way to decrease the number of signals. ES and NQ highly correlate. Many signals can be generated off our trigger points. So my trick is to add another instrument like RTY. So I extended the EG correlation indicator to EG correlation multiple, which is capable of monitoring two instruments for me. For instance, NQ and RTY. So NQ and RTY are being monitored in the background to produce correlation signals for me on ES. Similarly, we can replace RTY with YM. So NQ and YM can be monitored to produce correlation signals on ES for me. Some traders who struggled with inconsistent results improved after applying this approach. Their win rate improved, their risk was reduced, and their confidence increased dramatically. And now, guys, it's time to take action. Start tracking correlations and apply the third asset filter. In the next lesson, I will show you how to install the correlation toolkit so that you can try it for yourself and take advantage of it. And you know, trading doesn't have to be a solo journey. Join a community of traders who are already using these insights, sharing trade ideas and improving together. The best way to grow as a trader is to learn from others who are doing it successfully. So thank you guys for joining me.